Good afternoon, everyone. This is Chuck Self, Chief Investment Officer for iSectors. I'd like to thank you for joining us today to review the iSectors third quarter 2017 performance update. I will be providing a brief third quarter performance overview of all the iSector models and conclude with a research brief on the market. This call should last about 10 minutes with questions and answers to follow. Please feel free to ask questions anytime during or after the presentation by clicking on the chat box in the lower right-hand corner of your screen. This presentation will be recorded and a copy will be available on our website tomorrow at www.isectors.com. Just click on the iSectors blog icon and it will take you to a link to access the recording. We will also be sending a link to access a recorded copy of this presentation to all webinar attendees immediately after the call. Both Post-MPT Growth and Moderate bested their benchmarks in the third quarter. These strategies were helped by technology and financial stock allocations. Technology, led by mega-cap stocks, continues to be a leading sector. As presented in the chart on slide 3, technology, represented by FTEC in black, has been outperforming the broad market, represented by SPY in red, in response to growing demand and the hope for more favorable regulation and tax policy. In Post-MPT Growth, over 80% of the allocation is invested in financial, technology, and utility stocks. Post-MPT Moderate is more conservative, with strong allocations to Treasury bonds and technology. The iSectors Post-MPT allocations continue to outpace other ETF strategies. We are pleased that growth is ranked second among all 38 global allocation ETF strategies for 10-year performance in the Morningstar ETF Managed Portfolio Database. Investment advisors will be wise to consider Post-MPT Growth and Moderate allocations as core components for clients' portfolios. The global allocations turned in mixed results for the quarter. Although domestic equities outperformed global equities, they both fell behind the Standard & Poor's 500. Both equity allocations benefited from growth holdings, while global equity received additional performance from emerging market securities. The global fixed income allocation was positively impacted by international corporate weightings in the quarter. The allocation was hurt by short-term holdings as the Federal Reserve has been increasing the Fed fund rates. The iSector domestic equity allocation has earned very attractive returns over the past 5 years compared to most large cap blend strategies. In fact, the domestic equity allocation is ranked 14th out of all 636 ETF strategies in the Morningstar database for 5-year performance, even though it's been underweighted the high-flying growth stocks. The pairing of iSectors Post-MPT Growth and domestic or global equity has been a very powerful core equity combination historically. As we discussed in previous quarters' webinars, iSectors is pleased to announce our 15th strategy, the domestic fixed income allocation. As interest rates begin to rise, advisors and their clients need a strategy that attempts to minimize realized losses, earn attractive yields, while providing complete liquidity. The domestic fixed income allocation was created to meet these goals. As you see on slide 5, the portfolio consists of approximately 55% investment-grade corporate bonds and 45% high-yield corporate bonds spread over 2,800 plus issues. The allocation owns these bonds through defined maturity exchange-traded funds laddered from 1 to 5 years of maturity. These funds hold a diversified group of bonds all maturing in the same year. Monthly, interest earned in the fund is paid to shareholders. On December 31 of the maturity year, the ETF is extinguished and the undistributed principal and interest proceeds are released to investors. Since there's no trading in the funds and all the bonds mature before the ETF is extinguished, realized losses are minimized. With a current yield of 3.1%, you may wish to make this allocation a core holding in clients' fixed income portfolios. While the endowment strategy underperformed its benchmarks in the quarter, liquid alternatives beat the hedge fund index. As indicated by the black line representing the First Trust U.S. Equity Opportunities Funds, alternative equity funds were strong performers in both allocations. Both allocations are broadly diversified and aim to reduce total risk in client portfolios. Endowment allocation is the most diversified of the iSectors allocation and can be a one-stop solution for client portfolios. Also, the liquid alternatives allocation has outperformed hedge funds over the past 5 years. Given the advantages of the liquid alternatives allocation, including daily liquidity, complete transparency, availability to all clients, not just accredited ones, and a current yield of 2.6%, liquid alternatives will provide attractive risk-return characteristics when equity returns ease. The inflation protection and precious metals allocations rose during the quarter. As indicated in the chart on slide 7, broad commodity holdings, as represented by the IQ Global Resources Fund, GRES, helped inflation protection's results. Palladium bullion helped precious metals the most, as indicated by the strong performance of PALL, the ETFS physical palladium shares. We continue to believe that a 10% to 20% allocation to precious metals, inflation protection, and/or liquid alternatives will be worthwhile given our view that the next 5 years in the equity markets will not be as profitable as the last 5 years. The tactical global balance allocation matched the results of its 60% stocks, 40% bond benchmark in the second quarter. Emerging market equities, as graphed on the chart on slide 8, using the price movement of the Vanguard MSCI Emerging Market Fund, enhanced returns, in addition to international developed market stocks. The strategy has become fully invested in all global asset classes except for real estate. Finally, the chart on slide 9 indicates that capital preservation has earned almost 2.7% on an annualized basis over its 7+ year life, during a time of low interest rates. The yield is attractive with a short duration while maintaining investment grade quality on average. Capital preservation rose during the quarter due to high dividend short mortgage and high yield holdings. As the Federal Reserve has gone into more aggressive phase of raising rates, it's worth keeping in mind the long-term perspectives of such actions. The chart shown here on slide 10 shows the interaction of the one-year change in the personal consumption expenditure, or PCE, price index in red, and that's the inflation that's most followed by the Federal Reserve, and interacting with that, the 2-year Treasury yields in green. The 2-year best reflects the market's view on future Fed interest rate activity. A number of things are apparent from the chart. One, the 2-year tends to lag the actual movement in inflation. From the early 1980s to the early 2000s, the 2-year was higher than the PCE inflation rate. This led to a long decline in the 2-year. Most of the time since 2010, inflation has been higher than the 2-year, as we have experienced a slow, steady rise in 2-year yields. 2, currently, the 2-year is about the same as PCE inflation. In theory, if the Fed is focused on fighting inflation, the 2-year should be just slightly higher than PCE price increases. 3, during 2017, the 12-month PCE price changes have been decreasing from 2.2% in February to the current 1.6%. The 2-year Treasury is also currently yielding about 1.6%. If inflation remains steady or rises, the short-term rates are likely to rise. But if the declining inflation trend continues, we would expect 2-year yields to drop. On top of this analysis, the Fed continues to believe that inflation will reverse and begin to rise soon. This has led to the latest round of Fed fund rate increases. If they are wrong, but still increase rates, while they lower the amount of assets on their balance sheet, we will see a slowdown in economic activity, a further decline in inflation, and ultimately lower interest rates. Increases of investments in bonds and defensive stocks, such as utilities, is our model's major call at this junction. As you carefully inspect the disclosure page, we will now begin the Q&A portion of the webinar. If you have any questions, please type them into the chat box in the lower right-hand corner of your screen. We have our first question, and it's, would there ever be a scenario when using a blend of post-MPT growth and moderate be beneficial? Well, the answer is yes. There could be times when that would be worthwhile, especially if we're in a scenario where we continue to have low interest rates and thus be able to benefit from the relatively high amount of bond allocation in moderate, but still be able to take the advantage of the growth aspect of post-MPT growth. But that doesn't happen that often, and usually it's beneficial to use one of those tactical portfolios, post-MPT growth or post-MPT moderate, with something that's more strategic, like our domestic equity or global equity strategy as far as equities are concerned, or the domestic fixed income strategy or capital preservation on the fixed income side. So it all depends on the needs of the clients, and we would be happy to discuss that with you privately, depending on what your client needs are. Either Scott or I would be happy to discuss that with you. Are there any other questions? Seeing none, I would like to conclude by thanking everyone for attending our webinar this afternoon. If there is anything we can do to assist you with your wealth management or 401k asset allocation needs, please let us know. We could be reached directly at 800-869-5184. Again, thank you, and we hope you all have a wonderful Thanksgiving and holiday season.